The call calendar spread. This option strategy, sometimes called the bull calendar spread, is one that is most suited to market conditions where you believe the underlying financial instrument is going to rise within the short term, but not by too much. Over the longer term, however, the options trader is bullish on the underlying stock. Here's how the call calendar spread is constructed. You sell an out-of-the-money call option with a near-term expiration, and you buy an out-of-the-money call option with a longer-term expiration. Both positions normally have the same exercise price. The idea is to reduce your entry price by selling the shorter-term options and with the intention of riding the longer-term call options for profit. For this strategy to work, you don't want the price action of the underlying to spike upwards before the short-term option expires. These days with weekly options, you can come up with all sorts of interesting combinations of expiration dates to make this work for you. Your intention is also to take advantage of accelerating time decay on the out-of-the-money short options as their expiration date approaches. Expiration dates on the call calendar spread can be anything from 1 month apart to whatever distance into the future you wish to place your bought options. A 3-month difference in expiration dates is not uncommon. Some people are happy to close both positions for a small profit at expiration of the short options, while others would rather ride the long-dated bought option into potentially larger profits over time. It all depends on your long-term view of where the price of the underlying is expected to be. So let's look at a call calendar spread example. In this hypothetical example, we're looking at trading options on the Qs in an imaginary situation where we believe that it will continue to rise over the next few months. So with the Qs trading at $106, we decide to sell near-dated out-of-the-money call options at $107 strike, expiring in 20 days, while at the same time we buy $107 call options expiring in 50 days. The total cost is 69 cents per spread position, and since we've taken 10 positions, the total debit is $690 plus commissions. Now take a look at the image to the right, where we've analysed the payoff diagram. The middle vertical line is the current price. You'll notice that if the Qs are not above $108.78 at our 20-day expiration date, then a profit will be realised if both positions are closed simultaneously. But if the Qs fall below $105.24, we begin to realise a loss, which falls away up until a maximum of the $690 cost of the debit spread. So this is definitely a calendar spread with a bullish outlook. The maximum profit of $711 is realised if the underlying is sitting at the option strike price of $107 at expiration date. Now here are some important things to remember before creating a call calendar spread. Be sure to check that there isn't more than a 2% difference between the option implied volatility of the near-term options compared to the longer-term ones. If the longer-term options are too overpriced, the deal may not be as sweet as you imagine. Since this position is a debit spread, there will be no margin requirement with your broker. Experiment with strike prices. In this second example, we have taken a different approach. Instead of using $107 calls, we have chosen to go for $109 call options, which are further out of the money. So now our payoff diagram looks different, and our risk to reward ratio has also changed. This time, our position has only cost us $460 instead of $690, so that is our total risk. Our maximum profit, on the other hand, has risen to $849, which is almost double our maximum risk. However, we need to be more convinced that the price of the Qs will rise in the near term because, unlike the $107 calendar position, there is no room for a fall in price before we start losing money. But our upper level break-even point has risen to $111.40. Consequently, the further out of the money your call options are, the more it approximates a simple long call option position with a later expiration date, except that your entry price is much cheaper and the upside profit potential is also capped. You may be thinking that this sounds like a bull call spread. The difference between them is that if the price of the underlying rises too much and too quickly, you begin to see a loss if it doesn't reverse back below the upper break-even point before the short-term option expiration date.